Is the curve what you're thinking about the most right now, or what's the lead in your mind?
I wouldn't say I'm thinking about the China story probably more than the curve, but the curve is definitely front and center. I mean, it's a story that I think Jim summarized pretty well. It is a great indicator. I think you have to watch it, and more than likely we're going to see an inversion sometime over the next 12 to 18 months, and that's going to be a pretty good signal that 12 to 18 months from then, there's probably a recession on the horizon.
And as far as trade goes and the rhetoric we're seeing today, how's that needle move?
So I think, I want to steal Kyle's thunder because I know David's got him coming up in a little bit, but I think, a lot of the stories that the trade war is kind of working, I know it's not nice to say, are sort of true. I mean, things are going pretty well. This is not 2015, 2016, which a lot of people want to make parallels to. That was a very different story with the renminbi weakening. The renminbi is weakening here because effectively there's a growth grab coming from the U.S. Away from China. And I think the market's recognizing that, the stock market's recognizing it, the dollar's recognizing it.
So when President Trump says we can win a trade war, you agree with him?
Look, it's risky, and we could end up in a non-cooperative solution. It's a game theory. It's a prisoner's dilemma game, right? He's trying to force more cooperation by threatening a defection. We could all go to the uncooperative defection outcome, and it could be really nasty. But the odds of that happening are really low because it's probably a much worse outcome for the Chinese than the U.S. So I think the forcing of a more cooperative outcome, which means opening up in China, whether it's buying gas, opening up financial services, whatever it is, that's a huge positive for global growth, for U.S. growth, and ultimately, I think, even Chinese growth. So I think there's a great positive silver lining if you can cajole the Chinese into opening up. And I think what happened in Europe, with the U.S. and Europe seemingly getting together, maybe is a wake-up call, and China's about to kind of, maybe go through that transformation that we've all looked for, which is out of kind of communist and state control into something more market-based, which is, we had a story in the 90s called the peace dividend. Maybe there's another one around the corner coming out of China.
Gene, what do you think? You focused on trade, you focused on the yield curve. What's driving the markets in your opinion?
Yeah, I'd say much more trade, I think, at this stage than the yield curve. The yield curve seems, like an issue for a little bit further down the track, as David said. I think on the trade side, I would probably describe it a little bit more like a poker game where it looks like you have someone inexperienced and aggressive player at the table putting down a whole bunch of money and chips and trying to scare the other players into submission. Doesn't really seem like the best strategy to me. Because it's not really clear what the objective is. It really seems like, you can't really describe what the U.S. administration's end goal is on this. So it's not really obvious how it ends. It's not really clear what the off-ramps are for the U.S. administration. So it just sort of ratchets up and ratchets up. We have to put this in the context of a fiscally turbocharged cyclical boom in the U.S. That obviously has a limited lifespan to it, as David said earlier. We're seeing that in the yield curve. Interestingly, last week, for the first time in 10 months, you had U.S. data surprises actually start to turn negative. So this notion that the economy is bulletproof, I think, is probably not quite borne out by the data on a forward-looking basis.
But is that because of trade? I guess what I'm trying to get to here is David's point is, okay, there's a lot of noise about trade, but ultimately, as a percentage of the economy, not that big for the U.S., much more damaging to China. How much does it affect U.S. market trading here? Do you drive your asset allocation based on your concerns about trade?
Yeah, I think inevitably it does, but I think our starting point is more, valuations and whether or not it's attractive to take risk. And I think our view has been inclusive of the trade frictions, but also just as a function of a number of other factors, valuations aren't that attractive in most segments of the fixed income market, and so we've run lower risk as a result. I think the nuance on the trade discussion is really around what a bilateral trade war means for the United States versus a U.S. versus everyone else. And we think, U.S. versus everyone else may not turn out so positively for the dollar or for the U.S. Obviously, both can be potentially negative for growth. And we think we're probably in a pretty early stage, but what we would like to see and what would make us feel more secure on the risk side is that you actually see some of these off-ramps being left open, and it's not obvious to us that they are being left open.
To Gene's, I'm sorry, David.
Just, David, if I could just back away from trade for a second,
Sure.
because you did indicate earlier your belief that maybe in the next 12 to 18 months we get a recession. I think I'm quoting you correctly.
No. 12 to 18 months we get an inversion, and then the signal is usually 12 to 18 months from that
Okay, I'm glad
that we
you-
get a
thank you
recession.
for clarifying.
So I think it's really 24 to 36 is the first point at which you would look for a recession.
Would make this one of the longer cycles we've had, right?
I think the longest, yeah. But also probably the slowest growth as well. So cumulative growth has not been that high. So in a way, if you think about it, most recoveries were much faster snapbacks that then had a fall. So if you look at the cumulative growth rate, we got one of the slowest recessions on record.
Why do you think that is?
Regulation. I think we swung the pendulum really hard toward regulation. We slowed the economy down. I don't buy secular stagnation. I call it secular stagulation. And I think we had a lot of things that hindered investment, that hindered economic activity, and the usual drivers of growth, which are an investment cycle. A lot of those are being pulled back in the last 18 to 24 months. And what we're seeing is a huge change in investment. In fact, I think in the first 2 quarters of this year, investment was growing at something like 9.4% on an annualized rate, the fastest we've seen in the entire cycle. So I think that deregulation story, which we've talked about on the show
We're
before,
still not
it's a
seeing
really
the
big one.
productivity increases a lot of people
No.
expect, and or the wage increases, which we spent a lot of time Friday talking about when we saw that employment number.
Productivity has to come first, then the wages do, I think. But I think you have to get the investment to get the productivity. So this is a good sign that we're getting the investment at least.